I finished while I was working with section number 2. So chapter 4, this is the one period binomial model. Section number 2 is, everyone please pay attention, the example. The illustrative example, that's on page 99. So for you, it's going to be page 103. And we already did the D, the U, the price of the call on the up, the price of the call on the down. And we finally calculated that the call price is over there, 1402. The next one is 413, which is the hedge portfolio. And in our hedge portfolio is going to have calls 1,000 at what price? What's the price of the call?
74.2.
1402. Okay. And because we sell, pay attention, we sell the shorts, sell short the calls, we have a minus 14,000 and whatever, 20, okay? And we got stock. What's the stock? How many stocks? How many stocks? For 1,000 calls, how many stocks?
560.
566. Take a look, everybody, also camera. We calculated that. You gotta move the camera, man. Yeah. Yeah. And now zoom in nicely so that you can see H equal to 0.556. Okay. So this means that for 1,000 calls, you will have 556 stocks. Now we go back over here. This is called work, right? Stock 556, and the current price S0 is given to be S equal 100. So we're going to be paying, it's a cash outflow for us, it's going to be 55,600. Okay. So our hedge portfolio is going to have a total outflow of 41,000 and how much? 41,580. So we're going to spend 5,000 on the stock to buy the stock. We're going to get back 14,000 on the call. So we're going to spend a total of 41,580. Okay. So in this particular case, we're going to be spending 14,000 to 55. It's going to be a lot of money. We're going to be spending almost a quarter of the money on stock. So on 55,000, we're spending 14. That's 20% of the money we're going to spend on protective calls because of the extremely high volatility. Because the volatility is like 20–25%. So on a very high volatility, you'll need to spend a lot of money on protective calls. Okay? Or, of course, you can do the same with the put-call parity. I'm not going to get into that at the moment. All right, let's see what else we got. That's section number 3. 414. Overpriced call. Again, you can think, come on guys, pay attention. You can think of designing portfolios and all the other stuff, but it's very simple. If an asset is overpriced, you profit by selling. That's it. In finance, if an asset is overpriced, you profit by selling. We say it in finance, kind of like say it, we arbitrage it by selling. So, is it overpriced? Sell. Very, very simple. This is a general law in finance. It's the rule of making money. You sell overpriced assets and you buy underpriced. So if it is underpriced, you buy. So if the call is overpriced, here's the key. You will sell the call and you buy the stock to protect yourself. On the other hand, if it's underpriced, the call, you buy the call and sell the stock to protect yourself, to hedge yourself. So you always would have an asset like an option. If it's overpriced, you sell it and then you buy the underlying asset to hedge your position. Okay, and that's pretty much it. That's 415. And here in the textbook they construct for you a simple portfolios which show you how you can get excess return. So if it's overpriced, you sell and you get a excess return. Excess risk-free, excess risk-free return means that if the risk-free return is 7, you can construct a portfolio that you can get 10% or 12 or 15. You can get a higher risk-free return. It's an arbitrage return which is riskless above the risk-free rate. Okay? And that gets us to page 101. So for you, page 105, the 2-period model. Two-period model. So, chapter 4, section 2, and subsection 1 is, I'm not going to go to the great details. We did the major derivation, but we got something like a derivation over here. Let's see what's the derivation, what's the formula, how we go about it. Well, first is the notation. You got the call, okay? And if it goes up, its value we denote as CU. If it goes down, is CV. D. That's copy, nothing else. Now, if the CU can go up, becomes CUU. If it goes down, becomes CUD. Okay? And if it goes, CD goes up, becomes CDU. If it goes down, becomes CUU. Oh. Yeah, thank you. CDD. Now, this one. It is not necessarily true that CUD equals CDU, but in general, this is a good approximation. It's a good approximation that whatever it goes up is kind of like the same as going down. So this is the same as, at least for the stock, okay? The stock goes up 20%, goes down 20%, roughly, okay? So this is approximation, which is very, very useful to simplify. In other words, the model becomes very, very complicated, or a lot more complicated, but we can roughly say that, yeah, it goes up 20%, it goes down 20%. If it goes up one day, the next day goes down, we're going to end up in the same way as if it goes down and then up. So whether it first makes an up day and a down day is the same as a down day and an upward day. Okay? That's a reasonable approximation. Okay? So that's the one notation. The other notation is, we can say that CUU, meaning on two ways up, we can also designate as CU2. Doesn't mean U squared. It simply means 2 up days, okay? And similarly, CDD is just a shorthand notation. CDD is equal D squared. Now, you'll ask, well, we're not gaining anything from this notation, and it's absolutely true, but this notation is a little better, and I can show you immediately why. If it's a 2-step model or 2-period model, it's the same, doesn't matter. But suppose it's a 5-period model. And if it's a 5-period model, this CU will become CUUUUU. Okay? And obviously, it's a lot nicer and cleaner to say CU5. 5 times up. Okay? So, for more periods, it makes more sense. Okay? Similarly, CDDD DD equals CD5. Okay? So, for this, it's just a little more convenient when you get more periods. Okay? Is this part fairly clear to everybody? All right? So, now we try to do this. Let's first draw a little bit of a picture to see that we got a nice picture. Open page 104. For you is going to be 108. You start out, camera, right? Camera. You start with S, and S becomes S0, and then it becomes S1. Okay, S1 up, S1 down, right? And then becomes S2 up, up, S2 up, down, and then we got SD up, SUD becomes SDU, and then you got S2DD. Okay, maybe to be consistent over here, I could use the other way. It's the same thing, you understand. This designates the period of time. This is period 0 now. This is a 1-period model. Now this is a 2-period model, okay? And you got the stock. And correspondingly, you're going to have, for the stock at S0, you're going to have the call. And you're going to have the call at price at time 0. This is the current price of the call. And then the call is going to have a U price. In other words, the price of the call at the end of period 1 if the stock went up, and the price of the call if it went down. And then same thing, CU squared CUD or CDU, and I clarified the CDU is a reasonable, good approximation that doesn't cause any problems. And here you got CDD. So that's the one fairly straightforward picture, okay? And now we do the next trick, which is very, very, very simple and logical thing. Let me get the red one. And that's the following. If you know what's the price of the call here, and you know the price of the call here, pay attention now. Based on these two, you can get the CU. Okay? What's the probability over here? What's the probability over here? P. So I'm going to write here is P. And over here is 1 minus P. 1 minus P. Okay? So we got CU equal to present value, right? You can do the discount, 1 plus 1 plus, or 1 over 1 plus R, okay? Present value of what?
CU squared.
First we say P times CU2 plus 1 minus P times CUD. CUD. All right, so we got the CU. Now, we can do the this part, CD. What's the CD? PV, present value of P times CUD, right? Plus 1 minus P, and then CUU. Okay? And this one, close the bracket here. Okay, well let's check. CUD, CDD. Yes, thank you. Okay, so based on these two, using the probability, we got this price, CU. Based on these two, using the same probability, P, 1 minus P, we got the CD. So, we got the CU, we got the CD, and for a 2-period model, we can reasonably assume that we got 1 minus p. The probability is p, and 1 minus p. Okay? You basically can get, based on CU and CD, you can get C or C0. Well, let's do a little bit of writing, right? So, C0, or simply C, just a call, will equal the present value. It's a little tricky with these present values because you got first the 1 plus r for the one, and then 1 plus r squared for the other. Let me make sure that I got this piece okay. Becomes present value of, it's got to be p squared. Let's make sure I get this right. So p squared times c u squared, p squared c u squared. Yes, that's the probability of ending up here. Okay, next you got 2 times the probability of going up, and then the probability of going down, 1 minus p c u d. So this is the probability of going up and up. The probability of going up is p. The probability of going up and up is p squared. This is the probability of going up and down is p1 minus p. But you can also go down and up, so it becomes 2 times p1 minus p. Okay? So p minus 1p, up, down. The other one is down, up. And then plus, you're going to have now 1 minus p, the probability of going down, and then down is 1 minus p times 1 minus p squares, c d d. Okay? Or d squared, the same thing. Okay? Alright, so outcome on the up up, its probability, up down or down up, its probability, down down, its probability. Okay? When you sum this and this and this, of course you will get exactly 1. The probability is 1. And that's a simple two-way formula. Now, I may, because I'm already warmed up to this idea, we can do this if it's 3 times. If it's 3 times, okay? You want to try 3 times? Work like this. It's going to be S, U, 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 right? This one's going to be S, U, U, D, right? This one's S, U, D, U is the same as U, U, D, okay? Next one is S, U, D, D. And this one is, again, D, D, U. And then you got the last one is S, D, D, D. Okay? So, now we're beginning some basic calculation. And you can go 1 time, then you go 2nd time, then you go a 3rd time. And the call for 3 steps, okay, this present value is the same as 1. This is the same as 1 over 1 plus r squared, right? That's the present value. Here, is again the same present value, which is 1 over 1 plus our third, 3 periods, okay? And now we need some stuff here. First of all, what's the probability of going up 3 times? What's the probability of going up 3 times? P. So it becomes P to the power of 3 times CU3. Okay? That's on the one end. On the very other end is going to be 1 minus P to the power of 3 CD3. Okay? So you got a one-time chance of going up here, one-time chance of going up here. Well, how many times chance to go up here? You got one, this step here, one step here. So up, up, down, up, down, up, and down, up, up. So you got 3 different paths to go up. So it's going to be 3 times becomes plus 3 times becomes B squared 1 minus P, okay, times C U squared D, okay, and I gotta delete this, and so we got this piece is here, this piece is here. Now the next piece is plus 3 times P1 minus P squared. Alright, you guys pay attention. P, 1P squared becomes CUD squared. CUD squared. Okay? And then the last piece is, remember, 1 minus P to the third power. And then we got CD to the cube. CD3. And I close the bracket for the present value. Okay? So that's how you extend it. So this becomes a binomial. The first one is called binomial to the first degree. This is binomial to the second degree. This is a binomial or binomial to the third degree. And you can further expand if you want. 4, 5, 6. You can expand as many as you like in a similar manner. So this is a simple extension for a 3-period model. Let's take a look and see if it's in the textbook, just to make sure. Extensions. Where is the 3? I remember there was a 3-period model somewhere. Let's take a look, find it out. So extending the binomial, no. They just give you the general formula. They just give you a general formula. No? Okay, well that's good enough. So, we got the mispriced. We got the 2-period model. Okay, the illustration. So, 421 is derivation. So, 422 is example. (422) is example. So, you got S, remember, copy 100. So SU equal how much? SU is 125, and 125 times 125, calculator, is 125 times 125, what is it? Come on, guys. 156. 156, 25. Next one is SUD is 100 times 0.8 times 125, and these two cancel. It's just equal to 100, okay? And then SDD equals 100 times 0.8 times 0.8, and 8 times 8 is 64. 0.64 times 100 is 64. Okay?
Why does the 0.8 cancel with the 1?
Huh? 0.8 and 125.
Why do they cancel?
It just happens to be the case. This is 4/5. 0.8 equals 4/5. 125 is equal 5/4. So 4/5 and 5/4, they cancel each other. It's that we've designed it in such a way that an up and a down gives you this, cancels out, gives you the same old value. So if you have 100, when you go up and down, you end up in 100. If you go down and up, you end up in 100. That's a simplification, which is not a major problem. All right, so I will delete a little bit over there to show you over here what happens with the example. So the 125, when it goes up, becomes 156. When it goes down, becomes 100. When the 80 goes up, becomes 100. And when the 80 goes down, becomes 64. Okay, and now we do the calculation based on this example. Okay, so you're just following what happens. So for 156, okay? For 156, what is the price for 156? First, let's get the formula out. C equals P squared times CU squared, right? Plus P, 1 minus P, CU D plus 2 times here. Okay, let's make sure we get it right. 1 minus P squared CDD. Okay, and this all is a discount by 1 plus R squared. Present value. Present value for 2 periods. All right. So, first of all, when the stock is down and down, the call option is like how much? The stock goes down and down. The option is 0. So this space here is 0 times some probability. Okay? So when the stock goes down and down, the value of the call is 0. Next, when the stock goes up and down, the price is 100 and the value of the call is 0 again. So now the question is, what's the value of the call on up move? What's the value of the call? The price of the stock is 156. The exercise is 100. So you gain 56. So the value is 56. And what's the P? The P. P we calculate as, what was it? 0.6, right? That's the P, 0.6. So P squared is 0.36. 0.36. Divide by 1 plus R squared. So someone, calculator, what's 0.36 times 56? 7 times 6. It's got to be like 4.2. What is it? 4.2? The 0.36 divided by times 56. Calculator? 20.16. Now divide 1.07 squared gives us
1.145.
again
1.145.
1.14. Maybe 14. How about 14? $1.1 is going to be like 18. $1.1, that's about 2. It's got to be about 17 something. Again? 1769? 1769. Now what's the textbook saying for the example? $31.4, something doesn't, 0.6 times 0.6 times 56, 17 point, wow. We got it right, yeah? What is it? Which one? All right, guys, take a look here, page 105. So you go to page 109. And I got CU equal 31 equal 31.54. CD equal, of course, 0. And from here, C equals 1769. It's the same thing. All right? So they did it in 2 steps. First calculate CU and they'll calculate CD. I did it in 1 step by using the full formula. Okay? So basically, the future value of the call is $20. And when you convert back to present value, it's $17.69. Well, that's it. That's all the rest of it. In other words, it's 56 times 6, and now again times 0.6 again. All right, that's it. All right, now we get to some more interesting stuff here and more complicated. It's oh, by the way, I just deleted, did you remember? Just deleted that the call was $14 something, right? So, if it's a 1 period call, the price is 14. And if it's a 2 period call, the price is 17. So, you pay extra $3 to get an extra year worth. So the first year is worth 14. The second year is worth only 3. You pay only 3 extra to buy yourself a second year of a call. Okay? So this was the hedge portfolio for 413. That's the hedge portfolio for 1 period model. Now we go to 4, 2, 3. Hedge portfolio for a 2-year model. So, what's the hedge? Okay, guys, pay attention about the hedge ratio. What's the hedge ratio? Is the change in the price of the call. Let me see where we got it. Is 31.50, okay. Hedge portfolio. Let's make sure that I'm on the right page over here. So we got 31.54. So the hedge ratio, you take the price up and the price down. Pay attention where this is coming from. 31.54 comes as the difference between call up is 31.54 and call down is 0. Okay? So that's the change in the value of the call. Divide by the change in the value of the stock. What's the change in the value of the stock? Point? No, 45. Yes. 45. So, that's about 0.7. It's about what? 0.7? What is it? 0.701. So the hedge portfolio will be 701 stocks. And 1,000 short calls. Now remember, before we had only 500 stocks short. Now we got 7,000. Why? Before we had only 1 period call, and 1 period call was good for protecting 556 stocks. Now, a longer period call is good for protecting 700 stocks. So, longer calls have a better protective value, have a better hedge value, hedging value. So, you can hedge more by getting a longer call. Okay? So, that's your portfolio. And they give you, well, this is what happens when you go up and when you go down. Okay? And now here's the trick. Here's the trick. This is H. But there's a little trick. In a two-period model, if you go up, you will have a new hedge ratio. So, let's do this over here. So, you got H, and this is the hedge ratio from T0 to T1, okay? That's H0. Okay, let's put the 0 over here. In other words, this is the current hedge ratio that you have to initiate at time 0. But then you're going to have a different hedge ratio from T1 to T2. Okay? So, if the stock went up, you will have a hedge ratio for the stock going up, and you're going to have a hedge ratio for the stock going down. Okay? So, the hedge ratio changes. So, it is very important to understand that hedge ratio changes. So, from the first period to the second period, the hedge ratio goes up or the hedge ratio goes down. Okay? So that's the first part. And the second part is, if you want your portfolio to remain protected, you need to adjust your hedge. You need to adjust your hedge. Okay? And the adjustment of hedge from period to period is called dynamic hedging. So, dynamic hedging, guys, pay attention. I'm trying to tell you important stuff. Dynamic hedging is the adjustment of the hedge ratio from period to period so that you can remain hedged. Now let's take a look and see what's the HU and HT in the book. That's page 106, 106, and 107. So for you it's going to be 110 and 111. And you see that HU becomes equal to 1, and the HD becomes equal to 0. In the original, H was 0.7. So, if it goes up, you have to increase the hedge ratio. If it goes down, you have to reduce the hedge ratio. Okay? So when it goes up, you increase the hedge ratio. When it goes down, you reduce the hedge ratio. And now comes something very tricky and very important. We got a little time, but I'll finish with some real finance, because this is way too much theory. Okay, real finance. And within dynamic hedging, it's called portfolio insurance. And portfolio insurance is a partial hedging of a portfolio with calls or with puts or with futures. And now we get to something extremely important with people, which people didn't understand for many, many years, until later on the stock market crashed because of it. Let's try to discuss this part. Very tricky, but very important. So, suppose you have a portfolio insurance and you insure by, in this particular case, we insure our portfolio by selling calls. So, step one, sell calls, okay? So, you got stocks, I got stocks, okay? And I will protect myself by selling calls. Now, here's the trick. If I have 1,000 shares, I got 1,000 shares. If I sell 1,400 shares, calls, I'll be perfectly hedged. But I can partially hedge by having 1,000 shares and selling 1,000 calls short. I'm going to have a very good partial protection, okay? So, for one share, I sell one call. I'm not perfectly hedged, but I hedge myself, okay? Well, here's the trick. You run a major portfolio, you are long the stock market, and you sell, and you hedge your portfolio by selling calls. You're a portfolio manager in Thailand, you protect your portfolio by selling calls. And you sell calls, and you sell calls. And everybody in the room is protecting themselves by selling calls, okay? Now the question is, can you all be protected at the same time by everybody selling calls? And the answer is no, it's impossible, because the stock market has a risk. And when the stock market goes down, somebody's got to take a loss. And everybody cannot protect themselves. But here's the trick. You think you're protected because you sold a whole bunch of calls and they're going to make money for you. Well, you sell calls, you think you're okay. Step number two. Suppose now that the stock, the underlying, falls a lot, okay? Stock market falls. What is it you're going to do? Stock market falls. What is it you're going to do? If now you're losing money, you have to adjust your hedge ratio. You have to do dynamic hedging, okay? And what's the dynamic hedging when the stock goes down? When the stock goes down, you got to lower H. You got to lower H, okay? Okay? You got to lower H. You got to lower your hedge ratio. And now here's the trick. How do you lower your hedge ratio? How do you lower your hedge ratio? How do you lower your hedge ratio? Well, one will is sell stock. Okay? And when you sell the stock, in other words, you say, oh, Jesus, stock market is falling. I need to protect myself by, because you're losing on your stock, you need to sell some of your stock, okay? And when you sell some of your stock, well, here's the trick. What does it mean HD equals 0? What's the new portfolio? So, Before, the hedge was 701 stocks, right? And 1,000 short calls, okay? What's a new ratio of 0 mean? New ratio of 0 means 0 stocks and 1,000 short calls, okay? Do you see that part? So, you have to lower your ratio by selling the stock. And when you sell the stock, what happens? If you sell the stock, nothing happens. You're okay. But you sell stock, and you sell stock, and you sell stock, and you sell stock, what happens? Now, the stock crashes. In other words, stock goes down a lot. And when the stock goes down a lot, what's your response? Lower H. So, think of it this way. This example is not very good, and I'll show you why. So, H0 is 0.7. Then, you say, oh my God, stock market's falling a little. I gotta lower my H ratio to 0.5. Okay? So, you got 700 shares. You sell 200 of those shares. But you sell 200, and you sell 200, and you sell 200, and everybody sells 200. So when everybody sells 200 of your shares, suddenly stocks go down. And as the stocks go down further, you say, oh my God, 0.5 is not good enough. As the stock goes down, now you gotta say H2 is equal to 0.3. Now you sell 200 shares again. And you sell 200 shares. And you sell 200. And you sell 200. And everybody sells again 200. And that slams the stock down again. Okay? And you say, oh, 0.3 is not hedging me dynamically. I gotta go down to 0.1. And now you sell again, and you sell again, and you sell again, and you sell again. Okay? So, what you get is a feedback loop where stock selling causes by dynamic hedging more stock selling, and this more stock selling through dynamic hedging forces even more stock selling. Okay? And this means that everyone who was hedging and trying to hedge will keep selling and keep selling and keep selling until everybody is sold out. Well, who's going to be sold out? Until everybody who's trying to hedge is no longer hedging because they reached the hedge ratio of 0 where they don't hold stocks anymore. Okay? So, this is a classic mechanism of a stock market crashing where stocks feed into derivatives, and now the derivatives feed back into stocks, the stock feed into the derivative, and derivative feed back into stocks. And the feedback mechanism comes from dynamic hedging, where C is going down. Now exactly the same mechanism occurs, and that's what also occurred before it, futures. You hedge your portfolio partially with futures. I'll get to that in the second half. And as the stock market goes down, you sell futures. But if everybody sells futures, the futures market falls. And when the futures market falls, it drives arbitrage opportunity where, oh, the futures market is low. You sell the stock market, okay? And by selling the stock market, you drive the stock market down. Now, driving the stock market down forces more futures selling, which forces more stock market selling. And you got The stock market going down forces futures selling, which forces stock market selling, which forces futures selling, which forces stock market selling, until the whole stock market crashes completely, or until the market freezes, until there is no liquidity. Now, here's the last piece of some real good modern day finance, which is not in the textbook, but any good practitioner will know and understand. And you have to understand too. It's one of the foundations of the what's called most modern finance is the following. You got a portfolio insurance, okay? And you're insured. But if you insure, and you insure, and you insure, and you insure, and everybody tries to insure, when everybody is doing the same thing, we call this in finance a crowded trade. Crowded trade. A crowded trade is a trade which most of the crowd takes because they think it's a profitable one. So, portfolio insurance works only when a few people do it. When everybody does it, when you get a crowded trades never work. Crowded trades never work because when everyone's on the one side, when you start the other side, the moving in the other direction, you get a terrible feedback. So, crowded trades simply means everybody doing the same thing. This is the same as people going on the one side of a boat, and the boat leans on the one side. Now, when everybody starts rushing to the other side, the boat just turns around. So, when you have a crowded trade, the main risk is that, say, everybody bought, let's say, the calls, or let's say everybody bought the puts, and then everybody tries to sell the puts, okay? So, you got a long stock and a long put, okay? So, you got a portfolio. You got a stock plus protective put, okay? So, you got a stock, you got a protective put. Your stock goes down, now you gotta sell some put, okay? But you sell put, you sell put, you sell put. Everybody tries to sell the put, what happens? The price of the put crashes, okay? Or even worse. Because everybody's trying to sell it, there is no buyer on the other side. So, crowded trades got an extraordinary risk, which is known as simply the liquidity risk. When a trade is crowded, and everybody's on the side of buying puts, when everybody tries to sell, because it's crowded, there's nobody else to buy those puts. So suddenly, the puts become unsellable because everyone's trying to sell them. In this particular case, everyone's protecting with calls, and the protection requires to sell the stock. And if everybody tries to sell the stock, there's nobody on the other side buying. So, in a crowded trade, you got an extraordinary liquidity risk. And the more people try to protect themselves, let's say on the downside, the more exponentially rises the liquidity risk. So you are, as the trade begins crowding, you are trading off one type of a risk for a completely different type of a risk. And most people, when they were doing their dynamic hedging, they never really saw or understood their trade as a crowded trade. So, in finance, you got to understand that crowded trades always end up in disaster for the investors. Usually end up with a crashing or freezing market, or the market crashes and midway through the crash the market just freezes and there's no trade, or the market just closes on everybody. Okay? And you can't get out of your crowded trade. Okay? So it's very important to understand that hedging works only for the few who attempt the hedge. But if everybody starts doing the hedge, then the hedge does not work, cannot possibly work for everybody. Okay? In a hedge, there's got to be on the other side. Somebody's got to take the risk on the other side. And you can't, all of you, offload the risk to who else is going to take the risk. Okay? So that's the basic stuff on crowded trade, which causes or creates a liquidity risk. And for this, you need to know what others are doing to make sure that you're not doing the same thing. And of course, fund managers and investment managers and insurance managers and pension fund managers, they all like to do the same thing. They go, they have their dinners, they talk to each other, they learn, oh, I'm doing this and I'm doing that, and they all start doing the same thing. And soon enough, within a year or two, suddenly they all get into the same crowded trade. Example, you had a lot of hedge funds, and hedge funds kept trading and they had different strategies, but over the years, especially in 2012 and 13, all hedge funds began to use similar strategies. And when all of them began to use similar strategies, suddenly all hedge funds got into a number of different crowded trades. And in 2013 was an amazing year where almost all hedge funds lost money, even though they were supposed to get or to be hedged. And the answer is, you can't be if you are in a crowded trade. They are beginning to understand. They think they are outsmarting everybody else. But if you're smart enough, and you're smart enough, and you figure the same trade, and you figure the same trade, and you figure the same trade, and everybody figures out the same trade, and you put in the same trade, you're sure all to lose at the same time. Okay? So a trade could be winning when few see it and execute it. But when most see it and execute it, it will prove to be losing for almost everybody. Good enough for today? All right, cameraman. We'll continue next time with some.